In November 2025, Russia's finance minister went on state television and said one number: 99.1%. That is how much of all trade between Russia and China now settles in rubles and yuan, not dollars. The two largest non-Western economies on Earth built a new financial system. Most Americans never heard about it. But Russia is not alone. India's largest state oil company started paying for Russian crude in Chinese yuan. Poland's central bank bought more gold than any country on Earth for 2 straight years. A Chinese payment system most people have never heard of now connects almost 200 countries. This is not a conspiracy theory. This is not a prediction. This is plumbing, financial plumbing, and it is being rerouted right now. You're watching Curious Minds. Let's begin. The dollar has been the world's reserve currency for 80 years. Every barrel of oil, every central bank vault, every international loan, priced in dollars. But something changed. We are going to trace how the dollar became king. We will show what cracked the foundation, and we will explain what the new plumbing means for your savings, your prices, and your future. July 1944. 44 countries send delegates to a hotel in Bretton Woods, New Hampshire. The Mount Washington Hotel, white columns, red roof, nestled in the White Mountains. The war is not over yet. Allied troops are still fighting in France. But everyone in the room knows who is going to win. The question is not about victory. The question is about money. Specifically, whose money the world will use when the fighting stops. Britain sends John Maynard Keynes, the most famous economist alive. He is exhausted. He has heart problems, but he proposes a neutral international currency called the Bancor. It would belong to no nation. America sends Harry Dexter White. He proposes the dollar. Keynes has the better argument. White has the better leverage. The United States owns 2/3 of the world's gold. The dollar wins. Here is how the deal works. The dollar is pegged to gold at $35 per ounce. Every other currency is pegged to the dollar. If France wants to trade with Brazil, both convert through dollars first. The dollar becomes the common language of money. America becomes its only native speaker. Every global transaction now touches an American institution somewhere. That means every country on Earth needs a relationship with American banks. For 25 years, this system works beautifully. Europe rebuilds. Japan industrializes. Global trade explodes. But there is a catch nobody talks about. To supply the world with enough dollars, America must spend more than it earns. The more the world grows, the more dollars America has to push out. The more dollars it pushes out, the less gold it has to back them. The math is a slow-burning fuse. Economists later call this the Triffin dilemma. It is named after Robert Triffin, a Belgian-American economist who warned Congress about it in 1960. He sat before the Joint Economic Committee and laid it out plainly. The country that issues the world's reserve currency must run deficits. But running deficits erodes confidence in that currency. It is a trap built into the architecture from the beginning. Triffin told them exactly what would happen. They did not listen. By 1971, foreign governments hold far more dollars than America has gold to redeem. France starts sending ships to New York to collect its gold. Charles de Gaulle calls it a privilege without tears. Britain demands $3 billion in gold from Fort Knox. The system is collapsing. On a Sunday evening, August 15th, President Nixon goes on television. He interrupts the most watched show in America. He closes the gold window. No more exchanging dollars for gold. The Bretton Woods system is dead. But here is the part most people skip. The dollar does not fall. It gets stronger. Within 3 years, the United States strikes an informal deal with Saudi Arabia. America provides military protection. Saudi Arabia prices all its oil in dollars. Every country that wants oil now needs dollars to buy it. This is the petrodollar system. French Finance Minister Valéry Giscard d'Estaing gives the arrangement a name. He calls it the exorbitant privilege. The phrase sticks because it is accurate. The privilege is simple. America can borrow in its own currency at rates no other country can match. It can run enormous deficits because the world has no choice but to hold dollars. No other country in history has enjoyed this advantage at this scale. America can print money to fund wars, stimulus checks, and tax cuts. The rest of the world absorbs the inflation. No other nation in history has held this kind of monetary leverage. For 50 years, this system holds. But something is different now. The countries absorbing that cost have started building alternatives. February 2022, Russia invades Ukraine. Within days, the United States and its allies act. They freeze roughly $300 billion in Russian central bank reserves. The money sits in Western financial institutions, untouchable. They cut major Russian banks from SWIFT. That is the messaging network behind almost all international transfers. The message is clear. If you cross America, your money is not your money. This is the moment everything accelerates. Not because the sanctions are wrong, but because every central banker on Earth watches what happens to Russia. They all ask the same question: could this happen to us? The answer, for many of them, is yes. That realization changes behavior faster than any trade deal or summit ever could. Trust, once broken, does not wait for a replacement to arrive before it leaves. Start with the reserves. The IMF tracks what currencies central banks hold in their vaults. This data is called COFR, the currency composition of official foreign exchange reserves. In the year 2000, the dollar made up 71% of global reserves. It was untouchable. By the first quarter of 2025, that number dropped to about 58%. By the third quarter, it fell to roughly 57%. That is a 14-point drop in 25 years. And the pace is increasing. The curve is not flattening, it is steepening. Where is the money going? Not to the euro, not to the yen. The biggest shift is into what the IMF calls non-traditional reserve currencies. Smaller currencies and, increasingly, gold. Central banks bought over 860 tons of gold in 2025 alone. To put that in perspective, that is more than 400 metric tons above the 20-year average. Poland added over 100 tons. China, India, and Turkey together accounted for hundreds more. Gold does not carry sanctions risk. Gold does not care who is president. Gold does not answer to any government. But reserves are only half the story. The other half is plumbing, the actual pipes through which money moves between countries. For decades, that plumbing ran through one system, SWIFT, headquartered in Belgium, but effectively controlled by Western governments. Almost every major international transaction touches SWIFT at some point. Then the West used SWIFT as a weapon against Russia. It proved what the rest of the world already suspected. The pipes have a kill switch. China saw this coming years ago. In 2015, Beijing launched CIPS, the Cross-Border Interbank Payment System. It was small at first, 19 direct participants, a handful of countries. Most people in finance dismissed it as irrelevant. They called it a rounding error in global payments. Western analysts wrote it off as a vanity project. They were wrong, badly wrong. By the end of 2025, CIPS had grown dramatically. It reached 193 direct participants. Over 1,500 indirect ones joined across 124 countries. It processed over 180 trillion yuan that year. That was up 43% from the year before. Roughly $26 trillion flowing through a system most Western viewers have never heard of. Here is the detail that should worry Washington. 80% of CIPS transactions still use SWIFT for messaging, but the other 20% do not. That 20% is the seed of a parallel system. It is small today, it is growing fast, and it does not need Western permission to expand. Every percentage point it gains is a percentage point SWIFT loses. Russia built its own alternative too. It is called SPFS, the System for Transfer of Financial Messages. It is smaller and less sophisticated than CIPS. It lacks the global reach, but it handles domestic and some cross-border transactions entirely outside Western oversight. By late 2025, over 500 Russian and foreign institutions were connected to it. Between CIPS and SPFS, the architecture of a dollar-free financial network already exists. It is not theoretical. It is processing trillions. And every time the West sanctions a new country, more institutions join. Here is what every headline about de-dollarization gets wrong. This is not about one country. It is not about BRICS summits or press conferences. It is not about grand declarations. It is about thousands of quiet decisions. Central bankers, treasury officials, and oil traders in dozens of countries are all moving in the same direction. They are moving at the same time. No coordination is required. The incentive structure does the coordinating for them. Take India. In October 2025, Reuters reported that Russian oil traders began demanding something unusual. They wanted Indian state companies to pay for crude in Chinese yuan. Indian Oil Corporation, the country's largest state refiner, paid for at least 2 shipments in yuan. This is remarkable. India and China are strategic rivals. They have fought border skirmishes. They do not trust each other. But Indian refiners chose yuan over dollars anyway. The financial plumbing for dollar payments had become too slow, too expensive, too exposed to sanctions risk. The compliance paperwork alone added days to each transaction. When the cost of using the old pipes exceeds the discomfort of using new ones, people switch pipes. That is not ideology. That is accounting. India is not alone. The Shanghai Cooperation Organization has 10 member states. They include India, China, Russia, Iran, and Pakistan. Together, these nations represent over 3 billion people and roughly a quarter of global economic output. In 2025, 97% of trade among those members settled in local currencies. Not dollars, not euros, local currencies. That is not a pilot program. That is a functioning parallel economy. It serves roughly 40% of the world's population, over 3 billion people conducting commerce without touching the dollar. And then there is the commodity that built the petrodollar in the first place: oil. Saudi Arabia, America's original petrodollar partner, has publicly considered pricing oil in yuan. In January 2023, the Saudi finance minister spoke at Davos. For the first time in 48 years, he said something remarkable. The kingdom was open to trading in currencies other than the dollar. That sentence, spoken quietly in a Swiss conference hall, carried more weight than any BRICS communique. You are watching the most powerful currency on earth lose a war. Most people do not know this war is being fought. The weapon is not military. It is not economic pressure. It is infrastructure. Payment systems, currency swaps, and gold reserves are being quietly repositioned. The world watches other headlines. The plumbing changes underneath. China has signed currency swap agreements with over 30 central banks. The list includes Britain's Bank of England and the European Central Bank. These are not adversaries. These are America's closest allies. These agreements allow countries to trade directly in yuan. No conversion through dollars is needed. Each swap line is a bypass, a small pipe that does not run through American plumbing. 30 of them together start to look like a network. 50 of them will look like a system. But the most ambitious project is one almost nobody outside central banking circles has heard of. It is called mBridge. It is a digital currency platform. The central banks of China, Thailand, the UAE, and Saudi Arabia developed it together. The Bank for International Settlements oversees the project. mBridge allows central banks to settle cross-border payments instantly using digital currencies. No SWIFT, no correspondent banks, no dollars, no delays. A transaction that used to take 3 days clears in seconds. If CIPS is the alternative highway, mBridge is the high-speed rail. One country building an alternative payment system is a nuisance. 5 countries is a trend. But 30 countries signing swap agreements while buying record gold and settling oil in yuan, that is something else. That is a structural shift. And structural shifts, once they reach a certain velocity, do not reverse. They accelerate. Which brings us to the numbers that changed in 2025. In November 2025, Russian Finance Minister Anton Siluanov confirmed a staggering figure. 99.1% of all Russia-China trade now settles in rubles and yuan. 3 years earlier, that number was closer to 50%. The shift happened faster than almost any economist predicted. Western sanctions forced Russia out of the dollar system. China provided the alternative. Once the plumbing was built, there was no reason to switch back. Russia and China now trade over $250 billion worth of goods annually. All of it flows entirely outside the dollar. That is not a symbolic gesture. That is the world's largest bilateral trading relationship by volume operating on non-dollar rails. For context, that volume exceeds the total trade of most G20 nations. The pipes exist. The settlement systems work. The precedent is set. And precedents, in finance, are gravity. Once established, they pull everything toward them. Meanwhile, central banks accelerated their gold buying. The World Gold Council reported total central bank purchases of 863 tons in 2025. That was the 4th consecutive year of extraordinary accumulation. Before 2022, the annual average hovered around 350 tons. The current pace is nearly triple that level. Poland led the world for the 2nd straight year. It added 102 tons. That pushed gold to 28% of Poland's total reserves. Poland's central bank governor stated the goal clearly: 700 tons, for national security reasons. Think about that phrase, national security. A NATO member is saying this. Not a BRICS country, not an adversary of the United States. A close American ally is buying gold at record pace and calling it a security measure. Poland does not dislike America. Poland watched what happened to Russia's dollar reserves. It decided that no single currency should hold that much power over a sovereign nation's savings. That decision is rational, and rational decisions spread. China deserves separate attention. The People's Bank of China stopped publicly reporting gold purchases in May 2024. Before that silence, it had added over 300 tons in 2 years. Market analysts almost universally believe China continued buying. Some believe it accelerated. Beijing chose not to disclose the numbers. The reasons are strategic. Large disclosed purchases would weaken the dollar prematurely. They would raise alarm in Washington. They would also drive up gold prices. That makes future purchases more expensive. Silence is cheaper. Silence is also a strategy. And China is very good at strategic patience. Here is the pattern. Russia builds alternative payment rails. China expands CIPS globally. India pays for oil in yuan despite distrusting Beijing. Poland stockpiles gold. Saudi Arabia signals willingness to price oil in non-dollar currencies. None of these countries coordinated a single meeting about de-dollarization. They do not need to. The incentive structure is doing the work by itself. Reduce dependence on a currency that can be frozen with a keystroke. That is the only instruction required. That raises the question nobody in Washington wants to answer. Is this reversible? Can the United States stop this? More importantly, should it even try? The tool America used to maintain dollar dominance, financial sanctions, is the same tool accelerating its decline. Every time Washington freezes an adversary's reserves, 10 neutral countries quietly open gold vaults. They sign yuan swap agreements. They test alternative payment rails. The sword is sharpening the shield. The dollar has survived every prediction of its death for 50 years. Every single one. Economists have called its decline since the 70s. Commentators have predicted its replacement since the 90s. And the case for its survival is stronger than the headlines suggest. Start with the numbers that do not make headlines. The Bank for International Settlements surveys global foreign exchange markets every 3 years. The most recent data shows the dollar appears on one side of 89% of all forex transactions worldwide. The euro is a distant second at 29%. The yuan, for all the headlines about CIPS and swap agreements, sits at roughly 7%. In daily currency trading, the dollar is not just dominant, it is the atmosphere. And reserve diversification is not the same as de-dollarization. The IMF itself published a blog in late 2025 making this point. The authors argued that raw percentage shifts can be misleading. When you adjust the dollar's reserve share for exchange rate movements, the decline shrinks dramatically. In the second quarter of 2025, the dollar index fell more than 10%. That was its biggest drop since 1973. That decline alone accounts for most of the reported fall in the dollar's reserve share. Central banks did not sell dollars. The dollars they held simply became worth less relative to other currencies. The distinction matters enormously. Then there is the question of alternatives. For a currency to replace the dollar as the world's reserve, it needs 3 things: deep capital markets, free convertibility, and rule of law that foreign investors trust. The yuan has none of these. China maintains strict capital controls. Foreign investors cannot freely move money in and out of the country. The Chinese government can and does intervene in its currency markets whenever it chooses. No central bank will store its national savings in a currency it cannot freely withdraw. India has pushed back too. When Indian refiners started paying for Russian oil in yuan, New Delhi was not enthusiastic. India sees the yuan as a geopolitical tool. Replacing dollar dependence with yuan dependence is not liberation, it is switching landlords. India wants to trade in rupees. Russia wants rubles. China wants yuan. Everyone agrees the dollar should matter less. Nobody agrees on what should matter more. That disagreement is the dollar's greatest shield. And consider this. The United States Treasury market is the deepest, most liquid financial market on earth. Over $25 trillion in outstanding debt, traded around the clock, backed by a government that has never defaulted. When a crisis hits, any crisis, anywhere, global investors run to treasuries. Not gold, not yuan bonds. Treasuries. That instinct is not rational loyalty, it is structural reality. There is simply nowhere else to park that much money that quickly. Until that changes, the dollar's throne has no challenger, only critics. Where does this leave the person watching this? You have a bank account, a mortgage, a grocery bill. Here is where the mechanism meets your wallet. The exorbitant privilege, America's ability to borrow cheaply because the world needs dollars, is not an abstraction. It is not a theory in an economics textbook. It subsidizes your life every single day. If that privilege erodes, even partially, the effects are concrete and personal. Start with interest rates. The United States government funds itself by selling treasury bonds. It issues trillions of dollars in new debt every year. Foreign central banks are the largest buyers. They buy treasuries, not because the returns are spectacular. They buy because they need safe places to store their dollar reserves. That demand keeps treasury yields lower than they would otherwise be. Lower yields mean lower borrowing costs for the government. That translates to lower interest rates across the entire economy. Your mortgage rate is connected to this. Your car loan, your credit card, your student loans. All of them are cheaper because foreign central banks are parking money in American debt. This is the invisible subsidy most Americans never think about. Every month, you make a payment that is slightly lower than it otherwise would be. That discount comes from the exorbitant privilege. You just do not see it on the statement. It is the most valuable benefit you have never heard of. Now imagine those central banks slowly shift their reserves. Not abandon the dollar, just shift 10 or 15% into gold, yuan, or other currencies. That means less demand for treasuries. Less demand means the government must offer higher yields to attract buyers. Higher yields mean higher interest rates. Not dramatically, not overnight, but steadily, structurally, permanently. The floor under American borrowing costs rises, and it does not come back down. Then there is inflation. The exorbitant privilege means America imports goods from around the world. It pays for them in its own currency. Other countries cannot do this. Brazil must earn dollars to buy oil. Nigeria must earn dollars to buy machinery. America just prints them. That privilege keeps American imports cheap. If the world gradually requires fewer dollars for trade, that advantage weakens. The same goods cost more, not because they changed, because the currency buying them lost its special status. This is not a crisis scenario. This is a slow erosion, measured in decades, not months. But the trajectory is measurable. The dollar's share of reserves dropped 14 points in 25 years. Central bank gold buying has tripled from pre-2022 averages. Alternative payment systems now connect almost 200 countries. Each of these trends individually is manageable. Together, they describe a world quietly but deliberately reducing its exposure to the dollar. Once exposure decreases, so does leverage. And leverage, once lost, is extraordinarily difficult to rebuild. There is a historical parallel most economists avoid mentioning in polite company. The British pound sterling was the world's reserve currency for over a century. It dominated from the Napoleonic Wars through the Second World War. Britain's industrial output, its navy, its empire, all underwrote the pound's dominance. At its peak, the pound was used in over 60% of global trade. The decline did not happen in a crash. It happened in a series of small, rational decisions by other countries. The process took 40 years. By 1945, the transition was complete. Not because the pound collapsed, because the world changed around it. The United States is not Britain. Its economy is larger, more dynamic, more innovative. Its capital markets have no equal. Its military reach remains unmatched. But the mechanism of decline looks similar. Not dramatic rejection, just gradual diversification. Every country slightly reducing its dollar holdings. Every oil deal priced in a different currency. Every central bank adding a few more tons of gold. None of it is fatal individually. All of it is directional. And direction, sustained long enough, becomes destination. The people who will feel it most are not hedge fund managers or central bankers. They will adjust. They always do. The people who will feel it are ordinary Americans. Their wages are denominated in a currency that slowly, invisibly, buys a little less of the world each year. The privilege has always been invisible. Its erosion will be invisible too, until it is not. Here is what this episode is not. It is not a prediction that the dollar will collapse. It is not a warning to sell everything and buy gold. Those stories are easy to tell and easy to share. They generate clicks and sell newsletters, but they are almost always wrong. The dollar is not collapsing. What is happening is slower, quieter, and in some ways more significant than a collapse. The dollar is not being overthrown. It is being rooted around. Think of a large stone in a riverbed. The stone does not move. The river simply finds new paths. And the paths, once carved, do not close. Water has no loyalty. It follows gravity. The Bretton Woods system lasted 27 years before it broke. The petrodollar system has lasted over 50. Both were designed by human beings in specific historical moments. Both systems shared the same assumption. The world would always need dollars more than America needed the world's cooperation. That assumption held as long as there were no alternatives. Now, there are alternatives. They are imperfect. They are fragmented. The yuan has capital controls. CIPS still relies on SWIFT for most of its messaging. Gold cannot settle a trade invoice. But imperfect alternatives have a way of improving. That is especially true when the incentive to improve them grows stronger with every new round of financial sanctions. The first version of any system is always rough. The second version is better. The 10th version is formidable. Necessity is not just the mother of invention, it is the mother of infrastructure. And the world is building infrastructure at a pace it has never attempted before. The debate this episode cannot settle is whether the dollar's decline is inevitable or reversible, and it should not try to settle it. Smart people disagree sharply. Some economists argue that the dollar's network effects are so deep that no alternative can displace it within our lifetimes. Others point out that defenders of the British pound said precisely the same thing in 1920. The honest answer is that both sides have evidence. Neither side has proof. What is undeniable is not the destination, it is the direction. That direction reveals something uncomfortable about power itself. The exorbitant privilege was never free. Every country that held dollar reserves was making a bet. They bet the United States would manage its currency responsibly. They bet America would keep its capital markets open. They bet Washington would resist the temptation to weaponize the financial system for political ends. For decades, that bet paid off. The dollar was stable, liquid, and politically neutral enough. But neutrality ended in February 2022. $300 billion in Russian reserves vanished with a single keystroke. The bet is no longer risk-free. When a bet stops being risk-free, rational players diversify. That is not ideology. That is portfolio management. 80 years ago, 44 countries gathered in a New Hampshire hotel. They decided the dollar would be king. Nobody is gathering now. Nobody is signing a new agreement. Nobody needs to. The transition is not happening in a conference room. It is happening in gold vaults in Warsaw, in payment terminals in Shanghai, in server rooms in Shenzhen processing yuan-denominated oil contracts, in oil tankers settling invoices in yuan off the coast of Gujarat. It is happening in thousands of decisions so small and so numerous that no single headline captures them. But the river is moving, the paths are forming, and the stone, for the first time in 80 years, is starting to feel the current. Consider what that competition looks like in practice. A Brazilian soybean exporter sells to China. 5 years ago, that transaction settled in dollars. It was routed through a New York correspondent bank. It cleared in SWIFT. It was subject to American compliance laws. Today, that same shipment can settle in yuan through CIPS. It clears in minutes instead of days. The fees are lower. No American institution is involved at any step. The Brazilian exporter does not care about geopolitics. The exporter cares about cost and speed. Right now, the non-dollar option is winning on both. That is how reserve currencies lose their grip. Not in a dramatic crash, not in a single decision by a single country, but in 10,000 small transactions. Someone discovers that the alternative is faster. Someone discovers it is cheaper. Someone discovers it is simply less politically complicated. Each transaction is insignificant. 10,000 of them are a trend. The dollar did not become king because of ideology. It became king because it was the most practical option. The moment it stops being the most practical option, even at the margins start to widen. The most powerful currency on earth is not dying. It is learning, for the very first time, what it feels like to have competition. And competition, once it arrives, does not leave because you ask it to. Your dollar buys less of the world today than it did yesterday. The chart only moves in one direction. Subscribe if you want more stories like this. Is the dollar's decline something the US can stop, or something it caused? Tell me in the comments. This is Curious Minds. See you next time.